As we leave behind a week that's been dominated by central banks, we move into a new one that still has that same theme, with the Bank of England expected to announce their latest monetary policy decision this week. But there's plenty more to sink our teeth into. As we move into February, we see the beginning of the month kicking off once again with jobs data from lots of Canada, but notably out of the US, coming hot off the heels of the FOMC meeting and the core PCE price index metrics. How will markets take this latest announcement as we try to gauge the direction of travel for the US economy, and by that token, the direction of travel for monetary policy going forward? So here are the big ticket items according to Trading Economics. Essentially, we're looking at a busy start to the week and a busy end to the week. And that isn't always the case. A lot of the time we have quite quiet Mondays, quite frankly. But this time around, we're kicking off with manufacturing data out of China. Of course, absolutely key in terms of gauging the direction of travel for the Chinese economy when there's big question marks, but also a bit of hope. And certainly people are probably looking towards the Chinese market with more optimistic set of glasses on, because essentially we're now looking at an area that could be really battling with the US when it comes to the AI space. Whereas previously there was a feeling that they had probably been left in the dust of the US because of the export controls enacted under Joe Biden. Then we've got inflation data coming out of the eurozone and Italy. We've got the ISM manufacturing PMI out of the US on Wednesday. We've got that services PMI number, the ISM one. That's going to be absolutely key. Then Thursday, we've got that Bank of England interest rate decision, and rounding off the week with the payrolls number, jobs report out of the US and of Canada. But of course, everyone loves the US jobs report in particular. And so we're going to kick off with that focus on the US. Like I said, we've got those ISM PMI numbers coming out. Manufacturing on Monday, services on Wednesday, and Wednesday is also when we kickstart that focus on the jobs with the ADP payrolls. We've got the initial jobless claims coming out on Thursday, and then we've got the full jobs report on Friday. But the reason why I say that the ISM numbers are so key is that we saw within the last ISM services PMI that there was a spike in terms of the prices paid element. Now, services essentially accounts for the vast majority and pretty much all of the inflation within the US economy right now. It's not goods, it's services. And therefore, the spike that we've seen in terms of that prices paid element really is a warning sign. So this is going to be key, because we did see a market reaction. If we see another move upwards in terms of the prices paid element of that ISM services PMI on Wednesday, that provides the basis for potential strength in terms of the US dollar. And certainly that highlights the need to be able to look at a good economic calendar. So I would suggest you look at Trading Economics for it, because you can get that kind of breakdown in terms of the different underlying elements. Something like Forex Factory is really good for sort of top level stuff, but it won't necessarily give you the kind of granularity that you need on certain occasions. But like I said, we're really going to be crescendoing into Friday, where we see that jobs report with an expectation that we see a healthy 205K on the headline payrolls figure. That's down from 256. And certainly these 200K numbers are all very healthy indeed. So and the unemployment remaining at 4.1%, really putting to bed the idea that the US economy is in trouble. And then average hourly earnings 3.9. That's above where they need to be, really. So there's a need to drive down inflation. There's a need to make sure that the economy is doing well. But if unemployment's kept under control, if the payrolls are still printing at 200K odd per month, there's not really a massive need for the Federal Reserve to act right now. And, you know, we've just come off the back of a FOMC meeting, and they have really pointed towards some uncertainty. Essentially, they don't necessarily know that inflation's moving back down to target right now. There's some uncertainty, and a lot of that's going to come under Donald Trump. And so his policies won't necessarily be reflected in this latest data. But certainly what will be is the health of the economy and those underlying wage pressures. If the economy is strong and the wage numbers are strong, there's really no reason for the Federal Reserve to feel like they're going to be cutting rates too soon. Now, this comes as a caveat off the back of Friday's core PCE price index number. I provided a video about how important that's going to be. And you might be watching this video once that's been released, but I've recorded it prior to it. And so that's really going to provide the sort of backdrop to this week's data. And like I said, that ISM services PMI prices paid, and I explain it within that video. So check out that core PCE video. That's going to be key on Wednesday. And then Friday, the jobs report. We see strong jobs numbers. We see strong wage numbers. Really, it points towards the Federal Reserve holding off for the time being. Here's that sort of wide overview in terms of the jobs market right now. Unemployment, we sort of saw it basing, but we're not necessarily in the same kind of position as some of these other countries, the likes of Canada, which are really seeing unemployment moving much more sharply towards the upside. Unemployment pretty much leveling out really and pretty tame in the US. The payrolls you can see is on a downward trajectory, but that downward trajectory is just taking us back down to the norm after that massive volatility that we saw in terms of the pandemic and the disruption that made to the jobs market in itself. So it's sort of normalization, and we're back down to level where we're still seeing very strong job creation in itself. And you can see here in terms of the average hourly earnings, we're certainly way over and above where we were prior to the pandemic. If you look at all those sort of that big volatility, you strip that out. What was the norm? Well, the norm was more like between sort of 2 to 3% kind of thing. And so we are tracking back below that 4% mark. So we're getting closer to the norm, I would say, for wage growth. But certainly for the Federal Reserve, they're looking for signs of underlying inflation pressures. Now, the expectations around rate cuts from the Federal Reserve, despite the fact that the FOMC meeting didn't necessarily give us too much cause for optimism that they're going to be cutting rates anytime soon, markets have gradually started to warm up to the idea that we're going to see a number of cuts. You can see right now the base case scenarios are moved down to 375 to 400. That means 2 cuts over the course of the year. But you would say probably the biggest growth came in the expectation around a 75 basis point cut over the course of the year, which is down to 350 to 375. So some expectations growing. And certainly when I provided that video about the core PCE price index, it does highlight that, you know, if you look at CPI, yes, things are very concerning, but their favored metric thus far hasn't really taken off when it comes to inflation. And so it points towards a possibility that they could do more than some people are thinking. And certainly, you know, I was making that comment when people are talking about one rate cut this year. You know, I think that the back end of the year is where we could really see things get a little bit more interesting when it comes to rate cuts. In terms of the US dollar, this is the dollar index. Let's just put this in full screen. So we've seen this pullback of late coming into play, and part of this comes in line with the weakness in terms of the US 10-year, right? So if we put that on the chart as well, you can see here that we're tracking the US dollar, sort of tracking that 10-year at the moment. And the 10-year to a large extent also reflects expectations within markets around where interest rates going to be, where inflation's going to be. And so we've seen that sort of easing back a little bit of late. And I think some of that's really down to concerns around Donald Trump's tariffs, maybe not necessarily proving to be as justified as people had believed. And certainly talking about China and 10% tariff and that I don't actually want to really do it, you know, it doesn't really have the same kind of ring to it as the kind of stuff he was saying prior to being elected. So maybe we don't necessarily see that same kind of inflation coming into play. I've hammered home the point that I think that, you know, goods inflation isn't necessarily the big problem in the US, and goods inflation is what would happen when you see tariffs implemented rather than services inflation, which is the thing that really needs to be brought under control. So that to me would point towards it not being as much of an issue. But certainly if we look towards this week, if we were to see that ISM services PMI on Wednesday with a prices paid metric moving higher once again, I think that would provide the basis for strength in terms of the US dollar. At the same time, you've got that jobs report. And if we see more strength and strength in terms of the wage numbers, then you get the possibility of further strength for the US dollar. But you do have to bear in mind, you know, at what point do we start to see things turn? And it does feel like an interesting week that's just gone. You know, you're seeing claims from the Federal Reserve that, you know, things aren't necessarily moving back down to target. And so people are starting to sort of raise concerns over that. But ultimately, we've been talking about that for some time, and markets seem to price from one extreme to another. They swing from saying we're going to see 7 rate cuts in a year to 1 rate cut to 3. At the end, you sort of resolved at the right place. But, at 1, it felt like we were sort of undercooking it a little bit. And I think we're getting closer to the reality as we move towards sort of 2 rate cuts this year, 3 rate cuts this year. And with those shifts come downside for the US dollar, which is what we've seen at the moment. So at the moment, we're holding up at the 61.8 Fibonacci level, which is at 107,230. Over the near term, you can see that price action has sort of tried to regain a bit of ground since then. I would say certainly if we were to see a move up through your price swing high that we've got here, 108,510, then, you'd say, okay, that 61.8 is it. Essentially, it's played out, and now we're going to see the bulls back into play and feeding into this wider narrative that we've seen since October. Of course, because we've broken out from this range. So we've broken out from the range. We've now come back in towards the top end of that range. You can see here that sort of breakout level was at sort of 107.34. We've come back into that level, sort of respected it as support alongside the Fibonacci level. So if we break through that intraday swing high, then it does point towards the possibility of this currency moving towards the upside once again. And bear in mind, euro dollar index heavily influenced by euro dollar in particular. And euro dollar is going to be a key one this week because we have got the latest inflation data coming out. So let's jump onto that. Monday, we kick off with the latest inflation data out of the eurozone. I don't actually have expectations attached onto here. Let me see if it's been updated now. Excuse me, I probably should have. Let's go next week. Here we go. No, so still don't have it on there. Nonetheless, let's crack on. So ultimately, what we're looking at here is you've got headline inflation at 2.4, core inflation at 2.7. You've got that previous at 0.4, which is over and above where we need to be. So what we need to track here is whether we're moving in the right direction or the wrong direction. And sometimes you can get thrown off because you might see a rise in terms of inflation on the yearly figure. But in actual fact, if you look behind it, it's that monthly number that really tells us the true story of the direction of travel. And certainly, I think this is an interesting one at the moment when it comes to the eurozone, because what we're looking at here is this move higher of late. But actually, we're going to see big disinflation kicking in over the beginning of this year. Now, that might not happen this time around. And the reason for it is exactly like I said, it can be a bit confusing for people, right? We could see a monthly figure of 0.1, which is nice enough, or 0, and we could see year-on-year inflation rising. And that could very easily happen this time. And the reason is because if you look at this middle section on the left-hand side, that January figure of minus 0.4, that's what's going to be stripped out. So we're replacing that. We need to see minus 0.4 or below for us to essentially stay still. So there's a good chance we see upside in terms of that headline inflation metric this time around. But, even if we do, be aware, it's going to be fleeting, because look beyond that. February, 0.6. March, 0.8. August, 0.4. Sorry, April. May, that's when it sort of flattens out. And that's why I've got this sort of 6-month annualized on the bottom here, which is at 0.8. So it means in 6 months' time, we're currently on a trajectory to get headline inflation down to 0.8. In terms of core, where do we stand? It's very similar. So this time around, we're stripping out a minus 0.9, right? So there is a chance that we see a move higher in terms of the core CPI, higher in terms of the headline CPI. But that doesn't necessarily mean that suddenly we've bottomed out and inflation's a problem in the eurozone once again. Far from it, because instead you can see here that we've essentially got a expectation that we see 0.7 in February, 1.1 in March, 0.7 in April. All those stripping out, excuse me, that adds up to over 2% in itself, right? So if you look at that 3-month annualized, we're currently tracking on a pathway to 0.5% inflation, and the 6-month 0.7. So both headline and core inflation on a pathway to get well below that 2% marker. And so, the question mark here is, do we see a near-term move a counter trend move because of the fact that we potentially see a strong number this time around, because those base effects where we see those previous figures stripped out. Let's look in terms, excuse me, let's look in terms of the chart. Here we go. So this is the chart for euro sterling, and this is an interesting one that we've been sort of talking about of late, because we've got this very clear downtrend. So we're talking about the possibility of the bears coming back into play once again. That's exactly what has been happening over the course of the past 2 weeks. And so, you know, the question mark is, do we see a continuation of that coming into play? Potentially. But like I said, there's a caveat here. And the caveat is that if we see a rise in terms of headline and core inflation, that might make people think inflation's coming back into play in the eurozone. You might see headlines about, you know, an unwelcome resurgence in terms of inflation in the eurozone. That is not the case. Fast forward like 3 or 4 months, and we're going to see inflation at rock bottom levels in the eurozone. So, you know, there's a potential for a counter trend move. You can see that we've seen this pop at the sort of beginning, sort of middle of the day. This is around the US Open kind of time. And, you know, are we going to see this represent the bottom for this market? Certainly the fact that we've taken out this near-term high does point towards a possibility of us coming into a retracement phase. But maybe that retracement phase would be short-lived. Markets don't necessarily just move in a straight line. So we could retrace into here and then roll over once again. That is certainly a possibility. But I would say, you know, look out for this one, because it's going to be an interesting one about the possibility of a rise in terms of both headline and core inflation over in the eurozone. And it could have people believing that inflation is a problem once again. It's not a problem. And, you know, I think soon enough we'll see further rate cuts from the ECB. One caveat is that there's talk of the ECB removing the wording around monetary policy being restrictive. So question marks around quite how far they go from here will be abound. And if they soon enough think they've done enough to stimulate the economy and they don't need to cut much more, then you could see potentially euro strength coming into play. But as we see with inflation, if they're talking about getting inflation at 2% as a target of theirs, there's a good chance that soon enough they'll feel like they have to do significantly more, because they're currently on a pathway to get down to about 0.5 kind of area in by the end of this first half of the year. In terms of the final area we're talking about, it's the UK economy. We've got the Bank of England interest rate decision taking place on Thursday. There's an expectation that we do see a cut down to 4.5%. And, you know, you're really looking at this from the lens of thinking that we're not necessarily going to see a resurgence in terms of inflation. We saw weak inflation data coming out last time around, and that surprised people because, of course, we saw these new policies undertaken by the Labour government, which was higher national insurance contributions for businesses, higher minimum wages. Those things are inflationary by nature. And so it's a question mark of whether that's actually going to kick in or not. But markets are expecting that rate cut to come into play this time around. You can see here that the wages of excluding bonuses and including bonuses both moving towards the upside of late. So higher wages, that points towards the potential for higher inflation. CPI inflation also moving towards the upside. But there's question marks around that. You can see here services inflation, thankfully, moving lower. And certainly that is a trend where we're seeing underlying inflation declining, but you do see things like energy pushing up prices once again. Now, crucially, what we have seen is those fears around in the wake of the budget and around borrowing costs in the UK really start to abate, because you can see here on the 1 year, the 5 year, the 10-year yield in the UK, they've all been moving towards the downside of late. And if we overlay here the FTSE 100, I've got it inverted, we've seen the FTSE absolutely rocket at the same time. Now, you know, there can be a number of reasons for this, but certainly at that point in time, we certainly had been seeing UK assets being sold off in a heavy manner because people were fearful around the direction of the economy, but also the ability of the government to be able to maintain its spending pledges, because essentially the cost of borrowing was going up so much that it was cutting into their fiscal headroom and meant that they were going to have to cut back on spending, either that or raise taxes, which they said they wouldn't do. So that's less likely now. And we're starting to see really significant upside in terms of the FTSE, given the question marks we're seeing around some of the US markets at the moment with the whole sort of tech issue, it has sort of shone a light on the European sort of unloved European markets, and we're seeing the benefits it pretty heavily with the FTSE moving sharply towards the upside. Here's that outlook in terms of the Bank of England rate decision. There's 85% expectation of a rate cut, and from there onwards you can see the next rate cut priced in largely for May kind of time, and then there's a chance of another one at the back end of the year. So market's sort of pricing roughly 3 rate cuts this year. In terms of the latest moves for the FTSE 100, you can see that this big symmetrical triangle, we saw that breakout towards the upside, breaking into the record high levels, and we've seen a really dramatic push higher once again for the FTSE. So this is a index that's really in vogue and finding its feet as things stand. And so there's a question mark of whether we're going to see more of the same. And certainly if we see Bank of England taking a relatively dovish tone going forward and pointing towards further cuts over the course of this year, it provides the basis for people to think that it could be a good place to park some money at the moment. And certainly, we're looking at a year where possibly we might see some sort of resurgence in terms of China. We've got a big mining element and commodities element within this. The energy sector certainly doesn't necessarily sort of do too much in terms of strength at the moment, because of course we've got energy prices declining of late, but certainly Shell having a strong day's trade thus far. The financials are a good area of strength. It's in a particularly good spot because you've got elevated interest rates coming at the same time as the economy seems to be doing relatively well and is expected to be relatively strong this year. So the UK market, not necessarily as bad as people might think, and certainly that breakout points towards the possibility of further upside to come. So this pullback, the breakup through resistance, we're pushing onwards and upwards from here. If we break down through that 84.25 level, that's when it looks like we could see a wider pullback coming into play. But for now, when you see those kind of breakouts, you just got to expect more of the same until you're told otherwise. On the near term, you can see on the hourly time frame really dramatic gains taking shape at the moment. So I would say, I wouldn't necessarily chase it. Probably makes more sense to await retracements. If you're looking at long positions, different ways of trading that, you could wait for a retracement and a breakthrough resistance. You could wait for a retracement into a deep retracement, different ways of doing it. But, you're looking at a breakout move here coming in the lead up to a likely rate cut from the Bank of England, which should hopefully provide the basis for further strength going forward for the FTSE 100. I hope this has been useful. Make sure to check out all the other content we've got here at Scope Markets. My name is Josh Mahony, Chief Market Analyst. Have a great week ahead.